Fibonacci tools are based on the series of numbers identified in the 13th century by mathematician Leonardo Bonacci, commonly known as Fibonacci. The sequence is infinite, and each number is the sum of the two numbers before it. So 3 comes from adding up 2 and 1, and 21 is the sum of 13 and 8. The main characteristics of the sequence is that each number is approximately 61.8% of the next number, 38.2% of the following number, and 23.6% of the number after that. Trading platforms usually offer several Fibonacci drawing tools: retracement, extension, fan, arcs, and time zone. We'll focus on retracements and extensions as they're the most popular among traders. The concept behind Fibonacci retracements is based on a theory that after a significant movement, the price will pull back to a previous price level before continuing in the original direction, which means the Fibonacci levels can act as support and resistance. The opinions regarding which levels to use differ, but the three most common Fibonacci retracements are 38.2%, 50%, and 61.8%. The 50% level is not derived from a Fibonacci number, but is included because assets tend to continue moving in a certain direction after they complete a 50% retracement. Fibonacci extensions are used to identify take-profit levels, anticipate how far the price can reach once a retracement is finished, and establish potential reversal levels. The most common Fibonacci extensions are 61.8%, 100%, and 161.8%. All Fibonacci tools are based on ratios that are derived from what's essentially a mathematical irregularity without any logical foundation. While not fundamentally wrong, some traders would like to understand the logic a trading strategy is built upon. There is also an opinion that Fibonacci levels work only because many traders use the same levels to enter and exit the market, which makes them a self-fulfilling prophecy. However, this argument can be applied to all universal trading strategies, if not technical analysis in general. Another argument against Fibonacci retracements is that they can only point to potential reversals and corrections, not providing easily identifiable signals. All of that said, plenty of traders have made profits from Fibonacci retracements. Fibonacci retracements work best during long-term trends, so make sure you find the primary uptrend or downtrend. Then identify swing high and swing low points. A swing high is a peak reached by the price that forms when the high of a price is greater than the number of highs around it. A swing low is the opposite of a swing high. It appears when a low is lower than surrounding prices. When you've found the lowest swing low and the highest swing high of the main trend, use the Fibonacci retracement tool to connect the starting point with the end point. Once you've applied the Fibonacci levels, simply treat them as potential support and resistance levels. The most proven retracements are 38.2%, 50%, and 61.8%. No matter which direction the current trend is going, wait for a pullback to complete and open a position once you have a confirmation that the price has bounced off a retracement level. Don't forget to place a stop loss slightly below that retracement level for an uptrend and just above it for a downtrend, in case the price breaks through it after all. The commonly monitored levels for a strong trend are 38.2% and 50%, while in a weak trend the price could retrace to the 61.8% level. If you decide to use Fibonacci retracement levels, keep in mind that they're not to be treated as hard reversal points, but rather as levels to be aware of. You should always wait for a confirmation of a reversal from technical indicators. While Fibonacci retracements show where the price could stop its pullback and revert to the original trend direction, Fibonacci extensions help establish how far the price can reach before another retracement. To add the extension tool to the chart, you need to choose 3 points. The first point should be placed at the start of a price move, the second point at the end of it, and the third point at the end of the retracement. Subsequently, you will see extensions levels appear over the chart. Common Fibonacci extension levels are 61.8%, 100% and 161.8%. They act as potential resistance levels, so traders can use them to place take-profit orders or open positions in the opposite direction of the trend. Fibonacci extensions alone are not supposed to be used for making trading decisions. It's recommended to combine them with other indicators or patterns to confirm that the reversal is indeed about to take place. When applying Fibonacci tools to the chart, be consistent with choosing the reference points. Connect either wick to wick or candle body to candle body. Also make sure you correctly identify the main long-term trend, as less experienced traders tend to measure pullbacks in the short term, which leads to weak signals. Another common mistake is using Fibonacci tools on short time frames. High volatility during day trading means that support and resistance levels are less reliable, which makes it harder for a trader to pick retracement levels and set stop losses and take profits. Although it's worth noting some traders don't see it this way and apply Fibonacci tools even to tick charts. Finally, don't make trading decisions based on Fibonacci tools alone. Waiting for a confirmation from technical indicators like MACD and stochastic oscillators will help you avoid false alerts, increasing the probability of a successful trade.